Hello everyone, welcome to Drishti IAS. You're watching the Current Affairs Plus series wherein we discuss those topics that are making the headlines but are also important from a UPSC point of view. And in today's lecture, we are going to discuss the Union Budget, and needless to say, it is going to be presented on the 1st of February, but UPSC has also asked a plethora of questions on this topic. So without further ado, let's plunge right in. Let's see why this is in news. It is in news because it is going to be presented on the 1st of February 2026 by our Union Finance Minister, Ms. Nirmala Sitharaman. And this is going to be her 9th budget speech and her 9th budget presentation. So let's see the kind of questions that UPSC has asked from this topic so that we know the scope of our preparation and the limit to which we have to prepare. So beginning with the 2025 questions, very recent. Question says, consider the following statement. 1. Capital receipts create a liability or cause a reduction in the assets of the government. Now see students, here you're going to come across various concepts like capital receipts, borrowings, liabilities, all of which we are going to cover in the duration of the video. But let's first understand what exactly capital receipts are. So whenever we talk about budget, there are two components, the revenue budget and the capital budget. Now since the question is dealing with capital budget consists of capital receipts and capital expenditure. What is capital receipt? Capital receipts is that money, it refers to that money which creates liability and which reduces assets. Like what? Like what? Example, borrowings. Every time the government borrows, it creates liability or the legal obligation to pay back, and it of course reduces assets, right? So when the statement says capital receipts create a liability or cause a reduction in the assets of the government, the statement is accurate. The second statement says borrowings and disinvestment are capital receipts. We just saw the example of borrowing. Add to it disinvestment as well, because when the government is disinvesting, it is actually selling assets like PSUs or shares in PSUs, which is leading to a reduction in assets. So always remember, capital receipts, liability goes up, assets goes down. All right. So again, this is also correct. The third statement says interest received on loans creates a liability for the government. Now, when we talk about interests received on loans, any kind of interest, students, is an income source. It's a regular income source. It's a source for revenue, right? It is a source of revenue for the government. So, of course, it is not creating any liability because the government does not have to repay the interest, just like the government has to repay any borrowings. Hence, it is not creating any liability. The government is under no legal obligation to pay back or compensate. Hence, we can eliminate this statement. By virtue of elimination, we see that 3 options get eliminated, and therefore we arrive at the correct answer, which is option A for this question. Again, 2025 question, and a lot of students in this question got really confused. However, if we try to understand things, we'll realize that it is not really very hard. Now, a country's fiscal deficit stands at rupees 50,000 crores. It is receiving rupees 10,000 crores through non-debt creating capital receipts. The country's interest liabilities are rupees 1,500 crores. What is the gross primary deficit? Now, a lot of terms, a lot of jargon, a lot of concepts have been shot around in this question. For example, the term fiscal deficit, another concept of non-debt creating capital receipts, and then another concept of primary deficit. Now, before we understand these, which we will do eventually, let's understand the need of the question. The question is simply asking you, what is the primary deficit given the above data? What is the primary deficit? What do you understand by primary deficit? Primary deficit simply means fiscal deficit minus interest payments, which means if we simply understand this definition, it simply means whatever is the fiscal deficit of the government, if we subtract the interest payments of previous years that the government is due to pay, we'll actually get primary deficit. Again, what is fiscal deficit? See students, fiscal deficit is basically, it is a deficit, meaning the government is borrowing, the government is running short of funds. So that means the total expenditure has to be greater than the total income of the government. And if we subtract the income from the expenditure, we get to the fiscal deficit. When we talk about fiscal deficit, it basically means total expenditure minus revenue receipts plus non-debt creating capital receipts, which is the concept in your question, which means fiscal deficit already includes non-debt creating capital receipts, meaning that the amount that is mentioned here of rupees 10,000 crores is nothing but a trap set by UPSC in order to gauge the limits of your conceptual understanding, or how thorough are you with your concepts. So if we have the fiscal deficit, we know that fiscal deficit itself means you remove this part from the total expenditure, which means this need not be accounted into the question at all. Your question has simply asked you, what is the primary deficit, given that the interest liabilities is this. You simply put values into this formula. We know that fiscal deficit is 50,000 crores, and we know that the interest liabilities is 1,500 crores. You subtract and you arrive at the correct answer. All right, students, that's how UPSC sets a trap. It's a very straightforward question. It should not even take you more than 1 minute. But what we tend to do is we often tend to get lost in the detail. The devil is in the detail. Now, with reference to union budget, consider the following statements. 1. The Union Finance Minister, on behalf of the Prime Minister, lays the annual financial statement before both houses of the Parliament. Now, while it is indeed correct that the Union Finance Minister does lay the budget in front of the both houses of the Parliament, it is not true that the Minister does so on behalf of the Prime Minister. On the contrary, Article 112 says that the President shall cause to be laid before both houses of the Parliament the annual financial statement. The annual financial statement. The term budget is not used, and this is all contained in Article 112. So basically, the Finance Minister lays out the budget on behalf of the President and not the Prime Minister. Therefore, we can eliminate the first statement. When we eliminate the first statement, we eliminate options A and C by default. So we are left with B and D. The second statement says, at the union level, no demand for a grant can be made except on the recommendation of the President of India. Now, this again is a correct statement. So, Article 113, Clause 3 states that no demand for grant can be made or shall be made except on the recommendation of the president. So this statement is correct, which gives us our correct answer, which is option number B. Again, the next question, a 2024 question. So you see, we had 2 questions from 2025 and we have 2 questions from 2024. The question says, which of the following statements are correct in respect of a money bill in the Parliament? Now, money bill also happens to be one of the favorite topics of UPSC. And when we talk about money bill, we know a few things and we can just revise it right here. The first statement says, Article 109 mentions special procedure in respect of money bills. Now, this statement is factually correct, and Article 109 actually explicitly mentions special provisions in respect to money bills. So, statement 1 is correct. Eliminate option B. Statement 2 says, a money bill shall not be introduced in the Council of States. What is the Council of States, students? It is Rajya Sabha. And as a matter of fact, this is again correct. And the money bill, any money bill, cannot be introduced in the Rajya Sabha. It can only be introduced in the Lok Sabha, and this is contained under Article 109, Clause 1. The third statement says, the Rajya Sabha can either approve the bill or suggest changes, but cannot reject the money bill. This is again an accurate statement. The Rajya Sabha can either approve or suggest changes. It cannot reject the money bill. And if the Rajya Sabha does not return the money bill within 14 days, then the bill is deemed to have passed by the Rajya Sabha. All right. So again, this statement is correct. Now, fourth statement. Amendments to a money bill suggested by the Rajya Sabha have to be accepted by the Lok Sabha. No, acceptance on part of the Lok Sabha is not mandatory. The Lok Sabha can either accept or reject any or all of the Rajya Sabha's recommendations. Hence, fourth statement is wrong, which means our correct answer is option C. Statements 1, 2 and 3 are correct. The next question says, along with the budget, the Finance Minister also places other documents before the Parliament, which include the macroeconomic framework statement. The aforesaid document is presented because this is mandated by A. Long-standing parliamentary convention, B. Article 112 and 110, 1 of the Constitution of India, C. Article 113 of the Constitution of India, or D. Provisions of the Fiscal Responsibility and Budget Management Act 2003. Now, at the very outset, let me make it very clear to you that the said document, which is the macroeconomic framework statement, is not mandated to be presented either by any provision of the Constitution or by any convention of the Parliament. Neither of these mandate the presentation of this document, which is the macroeconomic framework statement. So we can eliminate this as well as these two at the very outset. Now this talks about your budget, your annual financial statement, and Article 110 Clause 1 talks about money bill. Article 113 of the Constitution of India actually talks about demand for grants. So anyway, these options are incorrect, but also to know that no parliamentary convention and no provisions of the Constitution mandate the presentation of the said document. Therefore, even simply by elimination, option D would be correct. However, just so you know, yes, some provisions of the Fiscal Responsibility and Budget Management Act 2003, popularly known as the FRBM Act of 2003, actually mandates the presentation of macroeconomic framework statement. Now, what is it? It is Section 3, Clause 2 of the FRBM Act, which mandates documents like, of course, the said document, the macroeconomic framework statement, right? Also, the fiscal policy strategy statement, and then again, the medium-term fiscal policy statement. These are the documents that are mandated by Section 3, Clause 2 of the FRBM Act to be presented in front of the Parliament. All right? With reference to the Union Government, consider the following statements. 1. The Department of Revenue is responsible for the presentation of Union Budget that is presented to the Parliament. Now, the statement can appear to be very tempting to be marked as correct because budget has to do with revenue receipt, revenue expenditure, so on and so forth, sources of revenue. However, it is not the Department of Revenue, but the Department of Economic Affairs the Department of Economic Affairs belonging to the Financial Ministry. That is actually the nodal body that is responsible for the preparation of the budget. And therefore, we can eliminate statement 1, which by default eliminates option A and D for us. Second says no amount can be withdrawn from the Consolidated Fund of India without the authorization from the Parliament of India. This statement is correct. And this is actually Article 114. So the Article 114 mandates that no amount can be withdrawn from the Consolidated Fund of India without authorization by the Parliament. Now, this is factually correct. The third statement says all the disbursements made from public account also need the authorization from the Parliament of India. Now, what exactly is the public account? I beg your pardon. Public account consists of, let's say, small savings or provident fund. So, when we are talking about public account, it is the money that belongs to the public and you do not need authorization from the Parliament to disburse money from the public account. Hence, this statement is wrong and we arrive at the correct answer, which is option number C. Now, these were some of the questions that were asked. Let's also talk about some of the key features and constitutional provisions of the Union Budget. The Union Budget, also known as the Annual Financial Statement, is contained in Article 112 of the Indian Constitution. And like we said, the term budget is not used. It is Annual Financial Statement. Statement of the estimated receipts and expenditure of the government in a financial year. So, what is budget? It is a statement, a documentation of the amount or the monies received by the government and the monies spent by the government in a year. And what is the year? Financial year. Of course, it ends at 31st March and it begins from the 1st of April, the year the budget is presented for that year. All right. So it lasts till 1 year. Now, in addition to the statement of receipts and expenditure, the budget also contains estimates of revenue and capital receipts. All these terms, students, we are going to do as the video progresses. Now, when we are talking about receipts, we also have to talk about the ways and means to raise that revenue. All right. So the budget also contains that. Then, of course, there is estimates of expenditure, right? Again, when we talk about the estimates, we also want, for the purposes of prudence, that the details of actual receipts and expenditure of the closing financial year, along with the reasons as to why there was a deficit or a surplus, why there was extra money with the government or why there were shortage of funds with the government, that are also documented. Then finally, the economic and financial policy for the coming year, along with what? For example, taxation proposals, any new government schemes, any other amount of public spending that the government plans to do is also contained in the budget. Along with, of course, the first thing that we discussed, the simple estimate of revenue or a simple statement of revenue and expenditure of the preceding year. Now let us look at how the budget is passed in the Parliament. Now this process of passing the budget actually consists of 6 stages, or let's say 6 steps, and it begins with the presentation of the budget. We've already read that the budget is presented by the Union Finance Minister on the recommendation of the President or on behalf of the President. So the budget is presented in the first stage. Then there is a general discussion on the budget. So the budget is discussed, and at this stage, basically the ideas and direction of the government is discussed. For example, it is discussed which sector is the government going to prioritize. Is it going to be health, finance, or is it going to be defense? So this is discussed here, but no voting takes place at this stage. It is just the stage of discussion. Then the next stage is scrutiny by departmental committees. Now the budget is sent to the Parliamentary standing committees. And what these committees do is that they scrutinize individual ministries and the budgets proposed by individual ministries, the items allocated by individual ministries. So they scrutinize them one by one to see whether the demand for grants is fair and valid. Next, there is a voting on demands for grants. Now, this is the stage where voting actually occurs. So each ministry makes requests for demands for themselves, and then those demands are voted in the Lok Sabha. The Rajya Sabha has no role to play here. Voting is done only in the Lok Sabha. All right. Then the appropriation bill is passed. When the appropriation bill is passed in the Parliament, it actually gives legal permission to the government to withdraw funds from the Consolidated Fund of India. And finally, the finance bill is passed. What does the finance bill contain? It contains basically how the money is going to be, or the taxes are going to be raised. So basically, it talks about tax rates or the interest in or the increase in various tax rates. All right. Once this bill is passed, it becomes a Finance Act, and the stage or the entire process of budgeting is done. The budget passing is done. So here again, Department of Economic Affairs, Finance Ministry is responsible for preparing the budget. Now, this is the most crucial part of the budget in today's video. And we've seen that quite a few questions that we have discussed have contained these concepts that have been mentioned here. So, let's begin. We are discussing government budget. In very simple terms, what does the budget mean, or what does the budget do? It simply states where does money come from, where does money go to. That is the whole idea of a budget, to figure out what is the source of your income and what is the avenue of your expenditure. Now that that is sorted, let's see what are the components of a budget. So the budget has two components, a revenue budget and a capital budget. What is revenue budget, students? Revenue budget means that money that takes care of the day-to-day income and expenses of the government. Basically, it deals with day-to-day income and expenses of the government. All right. It also means that this budget has no significant or no direct impact on the assets and liabilities of the government. Now, because it is a budget, it consists of receipts and expenditure. So, revenue budget consists of revenue receipts and revenue expenditure. What do you understand by revenue receipt? Basically, in simple terms, you can say that revenue receipts are the regular earnings of the government, which the government does not have to repay. It is the money that the government earns regularly without having the legal obligation to repay that money. All right. What is revenue expenditure? Of course, it is the opposite. So, it is the amount or the money that is spent on running the government. That is spent on running the government. For example, the salaries, pensions, and other administrative expenses. That is the amount you need to run the government. All right. The qualitative feature of revenue receipts and revenue expenditure is that they have no direct impact on the liabilities, either of them, on the liabilities or the assets of the government. Now that we have talked about revenue receipts, how can the government earn money? What is the source of government's revenue? Well, the government can earn money through taxes or through other means. So, one becomes tax revenue, the other becomes non-tax revenue. When again we come to taxes, the government can earn money either through a direct tax or through an indirect tax. What is the direct tax? Direct tax is, for example, our income tax or corporate tax. These are direct taxes. It simply means that the burden of tax cannot be shifted to another person, and the person liable to pay the tax will have to pay the tax. All right. Or we can have indirect taxes. Indirect taxes means, let's say, your custom duties or your GST. So these are the tax revenue or sources of revenue, tax revenues for your government. All right. There are also certain non-tax revenues. What are those? Or let me put it this way. Non-tax revenue becomes fees or interests that the government receives when they loan some money to states or to PSUs. All right. So your fees and interests is what constitutes indirect tax revenue for the government. So far, so good. Now let's come to the other component, which is the capital budget. Capital budget, in simple words, has to do with long-term finances of the government, whether it's receipt, whether it's expenditure. It is long-term. When we talk about capital receipts, and we have already discussed this, but I'll still tell it very briefly, it refers to money that can increase liability and decrease or reduce assets. And the examples we've already seen are either government borrowings or they are disinvestments. All right. When we talk about capex or capital expenditure, we are talking about that money which does the opposite, that helps to create assets, right? That helps to create assets and reduce liabilities. So what kind of examples can be given here? So for example, infra expenditure on let's say building roads, hospitals, schools. Government is actually creating assets. Also, the loans that government grants to other states, so that is also creating an asset in the sense that they will keep receiving certain income payment in terms of interests. All right. So this is the entire budget in a nutshell. Here you can go through the details of these concepts that I have explained. Now again we have to talk about deficits, because fiscal deficits, revenue deficits, primary deficits, these are very much usually in the news, and also UPSC, as we've already seen, has asked a few questions on them. So let's first look at what exactly is revenue deficit. Now when we talk about revenue deficit, one thing is certain, that it has to do with revenue budget. Whenever there is a deficit means there is a want or shortage of funds. Why would there be a shortage of funds? There would be a shortage of funds if the spending or the expenditure of the government is greater than its receipt, its income. And therefore, in very simple terms, revenue deficit is revenue expenditure minus revenue receipts. So, of course, it is only dealing with the current income and expenditure of the government. All right. Again, when we talk about fiscal deficit, this is again a concept that we have discussed previously. Fiscal deficit is actually the total borrowing of the government. It equals to the money that the government needs to borrow during that year. So, of course, it has to do with total expenditure and total receipts. Now, when we talk about total receipts, of course, we are going to have revenue receipts and then we are going to have capital receipts. But when we talk about capital receipts, here we have to count only non-debt creating capital receipts, which means, for example, we may have disinvestments or we may have borrowings. Borrowings is going to create a debt. So here we do not have to count that. All right. Hence, fiscal deficit comes up to this formula. And of course, it is the total borrowing requirement of the government during that year. Another related concept is that of primary deficit. Again, we have discussed this. Let's quickly browse through. Primary deficit equals fiscal deficit minus interest payments. And what does it indicate? It indicates a gap between the government's expenditure requirement and its receipts, not taking into account the expenditure incurred on interest payments on loans taken during the previous years. In very simple terms, I am subtracting the interest payments that is due on previous years from my fiscal deficit. That actually amounts to primary deficit. All of these concepts have been discussed in the beginning of the video while solving questions, and now that we have done this, I hope you're going to go back and check those questions out again, and it's going to make your life much easier. So finally, we have reached the end of the video, and I hope this video has been helpful to you. I've brought to you a practice question. Please let me know the answers in the comment section. If you found this video useful, if you thought that at least some basic concepts related to the union budget were clarified for you or something made sense, kindly like, share and subscribe. Thanks for watching.
For more informative content, like, share and subscribe, and do not forget to press the bell icon to get the notifications.